Welcome to our talk on charitable giving the right way. I'm Brian Akers, and here with me is Jeff Akers. And what we're going to be doing today is talking about charitable giving. Charitable giving the right way begins with a desire in your heart to give. This desire to have an impact on the world around us. Giving is a byproduct of experiences in your life. The show, this talk, the webinars today is all about taking this passion for giving and giving you the tools to give the right way. But before we can go too far, we do have to cover disclosures, right, Jeff?
Yes, we do. They are mandatory. Now, you don't have to worry about a test at the end or anything, but you do want to know in that bottom paragraph there, it's got Brian and myself and Alex and Bernie listed. Our broker dealer is Kalos Capital. They're located down in Alpharetta, Georgia, just outside of Atlanta. And our registered investment advisory firm is Kalos Management. So they provide oversight for us and keep us on track, make sure that we're in line with the regulators.
Anytime we talk about investments or ideas, we highly recommend you meet with one of us before you act on it. Don't just take this information and go running with it. So make sure you have a financial advisor be there with you to guide you through all the aspects of these things that we're going to talk about today. All right, what we're going to do is begin with Jeff is this question. When it comes to giving, where does it all start?
Well, it starts with your heart. Where is your heart? What are some things that you're passionate about? What are some things that you want to make sure that you're taking care of? And maybe even something that lasts beyond you. That's where the legacy comes in, building a legacy, and just that desire to help people. Personally, for me, it's also the fact that God instructs us to give and to help others. And so that's one of the things that makes me want to give. And then what we'll talk about today is the how to do that, how to do the giving that we want to do.
When it comes to where do you start, it also starts that God instructed us all to give. And so there's many ways of talking about this. We're also going to talk about a passion for a certain charity that leads you to want to give. And then there's the thought of building a legacy. An example might be a scholarship or an endowment fund that you set up for some charity or for some need. And of course, the overall willingness to help people leads people to want to do charitable giving. But let's go ahead and begin with where does it start when it comes to where is your heart?
So Jesus said, for where your treasure is, there your heart will be also. And in this particular verse, he's talking about store up your treasures in heaven, because in heaven, things don't get destroyed. Here on earth, you buy something, it'll rust, it'll decay over time. But if you give something towards something eternal, that lasts forever. And so where your treasure is, there your heart will be also. Give to where your heart is. Also, in the Old Testament, in the book of Malachi, God says, bring the whole tithe into the storehouse, that there may be food in my house. And then God says, test me in this, says the Lord Almighty, and see if I will not throw open the floodgates of heaven and pour out so much blessing that there will not be room enough to store it. This is one of those places where God says, test me, try me, see what I do. And it kind of gets to the point, we've heard it before, of pay it forward. If you give, things end up coming back to you. You actually receive a blessing from that gift. So these are just a couple of things that God has told us through the Bible about giving. Like Brian said, there are many, many more in there, and he gives us a lot of instruction about how to handle money, and in particular, giving.
Well, this is all important because of many, many changes that have occurred over the last couple of years. The Tax Cut and Jobs Act of 2018 changed the standard deduction, where we used to all itemize, and now most of us use the standard deduction on your tax return. So what happens is that in most cases, our charitable giving does not count for a deduction on our tax return because we have the standard deduction. We don't have enough. What we put up here on the screen is the Schedule A. It's probably too small to see, but generally up here in the top part says medical and dental expenses. And then we have a section on taxes you paid. They call that the SALT deduction, state and local income tax deduction. You're limited under this category to $10,000. It counts real estate taxes, your state income tax, all in one category. And then it counts the interest that you pay on your mortgage or home equity loans or second home or boat or camper, depending on if it has a bathroom. And then it has a section for charity, and the charity amount comes in here. And then there's the casualty and theft losses. And that's about it when it comes to deduction on itemization anymore. So one of the things about giving to charity is sometimes we do it, we love the tax deduction, but in reality, because of standard deduction, people are not receiving a tax deduction for what they're doing. So we're recommending a few different things. One of them is to group the deductions all into 1 year, where you can say, this year I'm going to take all my deductions, and the next year I'm going to basically pay it all to charity this year. Next year I won't pay anything to charity. I'll save it up for the next year. So every other year you might deduct it. Those are some ideas I was thinking about, Jeff. How about you?
Right. So I like the idea of grouping deductions. We're going to talk about a couple of ways that you can do that down the road. But because of the Tax Cut and Jobs Act and the standard deduction that came out of that, you can see here that for a single taxpayer, the standard deduction is $12,550. For a joint couple, that standard deduction is $25,100. And if you're over 65, there's an additional $1,350 per person that you can deduct. So that's a really high threshold to meet with your state and local taxes, which, like Brian said, it's capped at $10,000. Mortgage interest, well, if you're retired and you've been listening to us, you don't have a mortgage right now, and so there's not going to be mortgage interest. Hopefully you don't have medical expenses that meet that kind of threshold, and hopefully there's no casualty or theft that you're going to be deducting. So if you've got just the $10,000 in state and local taxes, are you going to give $25,000, $27,000 in order to reach that threshold? Or are you going to give that other $15,000 or $17,000 to charity? And I think there are some other ways that we can manage that in order to go past or to get the standard deduction plus have the charitable deductions. And then, like Brian said, with grouping our gifts to charity into 1 year, if we were going to give $10,000 in a year, then we could give 20 and just do every other year, and then 20,000 plus our 10,000 state and local, or $30,000. So it makes sense to itemize our deductions. So that's just the tax changes that happened a couple of years ago.
Yeah, there's one other piece, and that is for $300. So if you give away $300, you actually can take that off your taxes and use the standard deduction. So you should still turn in your charitable gifting that you do out of your regular checkbook. You should give that to your accountant to do your taxes, to take a deduction. That's on the 1040, works out very well on the federal. So Jeff, any final thoughts on your clients or a case study you might have that basically why is giving so important?
So there's a case where there's a couple that we say, give where your heart is. Well, their heart's for kids. They'll like to give to things that help kids, assist kids in overcoming illnesses and things like that. So they might like to give to something like St. Jude's or the Shrine or something like that. And then this particular couple, they reached RMD age, required minimum distribution age. And so they used a strategy you've heard us talk about before called qualified charitable deductions or distributions. So they gave money directly from their IRA to the charity, and then that money comes off of your taxes without having to use itemized deductions, the Schedule A. So they're able to take advantage of that, not pay tax on the required distribution, and at the same time, get the standard deduction, and it really can benefit your taxes. Now that's a simple one. You've heard us talk about that one 100 times, and we're going to cover other things today. So that's what we're going to do next.
Absolutely. We're going to cover a story about a client that came to us and said that they wanted to give it all away. And then I want to explain how we tried to help them. So my case study that I'm going to go over is about a client who came into the office, and basically as he walked in, it was him. He's married, but his wife did not come to the first meeting. He said, Brian, I really wanted to talk to you about giving everything I have away. but I need you to calculate what I need for retirement for the rest of my retirement years. His wife and him were she was over age 80. He was a little bit under age 80 when we first met. And basically the talk began by doing retirement planning to see how much they needed to keep to be able to afford their retirement years. And then they had to do a lot of basic financial planning when it comes to planning that out throughout, projecting all the years ahead. And then what he wanted to do was to give the rest away. And so I've never had anybody really wanted to give it all away, but that was one of the thoughts that he had. So we wanted to begin our process of doing financial planning, of going over some things. The first thing we do, the step one, was where we sat down and did basic retirement and investment planning, calculating what he would need. And then what happened was we figured out that him and his wife had an excess. There was more money that they could give. And he had certain charities in mind. And he had already contacted some of the charities about some thoughts he had. And so we started working on that, where we established endowment funds at 3 different universities for scholarships in the future. And we came up with a name of the endowment fund at each place. We did not use the client name. We used another name that was as a biblical name, because his giving was to Christian colleges. We wanted to support seminary people as they are getting ready to graduate, so they have no debt. So we set aside scholarships for that purpose. So we gave away money at that time to fill those up. That created a charitable deduction for that calendar year that was much more than his income. And what we're able to do is use basically a carry forward of the charitable deduction into the future. Back then, you used to be able to deduct 50% of your income with charity. There was a limit to that, and the rest of it would carry forward. Now, under the Tax Cut and Jobs Act 2018, we can deduct 60% of our income with charity, and then it carries forward to be used in future years. As we're going through this, the client had IRAs, they had personal money, even had tax-free bonds, which we didn't really need that anymore, because with all the charitable giving, we're going to have a very low taxes to the future. So one of the things we looked at doing was converting IRAs, where you pay tax now, into a Roth, and that became an inheritance for his family. His family, that would be tax-free to them. And by paying the tax, which then had the charity against it, it cut the tax in half, which worked out very, very well in the calculation. So that combination of charitable giving, then Roth conversion, all in the same year, start to use up more and more of the actual charitable gift that we used on that. So we started out with the calculation of retirement planning. We started talking about estate planning and how to make sure money passed to the family and money passed to charity. What we wanted to do is make sure the IRA's beneficiary was a charity, so that the family would not pay tax on that. We like the Roth IRA because it's tax-free to the family. And then we like regular accounts because they have a step-up basis, and money would pass on to the family that way without paying a lot of tax. So we had the beneficiary of the IRA to charity, so that instead of having a taxation on that tax-deferred money, we're able to give it straight to charity. We can do this with any charitable, any IRA, and with someone who has a charitable intent. Under the newest rules, the Secure Act of 2020, one of the things we have to watch is that your IRAs you want to give to charity must be separate from IRAs you want to give to family. And that's to give your family more ability to draw that money out over time. Up to 10 years is the new rule. They're no longer allowed to stretch it over a lifetime. Very important to understand that. Now, the other thing we tried to do is we wanted to specialize giving upon death. Now, in a will, if you write down to give to this charity if I pass away, the estate gathers the money and gives it to charity. They might give money that has a step-up basis to charity, and you can take that off you won't owe any tax on that of any sort of it, but you avoid the opportunity to avoid the taxes on the IRA. So it's very important to change some beneficiaries and change the estate plan. So that key thing that we're trying to work on there was designing a plan, tax efficient, met all the goals of trying to give things away. And then we worked through the plan year by year. What happened a few years later is his wife passed away, and he came back in. He goes, I want to recalculate again. I need less now. I want to give more away. And so we sat down, calculated that, figured out ways to do more giving. And we worked on a way through this one investment opportunity through universities called a charitable gift annuity, where what you do is you give the charity money, and then they give you an annuity payment, usually a quarterly payment for the rest of your life. Whenever you pass away, the check stops coming out, and the rest of that money stays with the charity. So in this case, once you're over 80 years old, that payout is very high. It's in that 8 to 10% payout. It's an excellent way to get more income, to be able to provide for your needs, but also fulfill the goal of giving to charity. So in this case, it was a case where, I guess for me, I got really involved with trying to help him and make sure his wishes happened. And one of the key things was, I guess the night he passed away, I was able to go visit him, not knowing he's passing away that day. But what happened was, I was in the room and he motioned to me, and I went closer to him, and he asked me, actually said to me, he goes, "Brian, I need you to make sure the plan follows through. Make sure the money gets where we intend it." And I said, "Yes, sir." And that was like one of the final words I had with him. It was really wonderful to be able to meet a guy like this who had a heart to giving, a heart to provide for many, many people he never knew. And then what we did after that is work through the estate and through the trust and through the beneficiaries, and ended up giving some more money to charities. And that was a very enjoyable time. One of the best things we got to do was me and a family member got to go visit some of the charities that he had put into his trust, and go visit and give checks to rescue missions. That was a lot of fun that day, to get a tour of rescue mission, at the end, give them a check. We did 3 in Baltimore City. That was awesome. One of the highlights of doing that. So charitable giving, when it comes to it, we think about giving it all away. We don't have to give it all away, but we can give away what we believe is the amount that's proper. And whatever that purpose is, whatever that charity is, there's a way of doing financial planning to make it happen. The rest of this talk we're going to have is about other ideas, concepts, things that help us give money to charity in ways that are efficient, tax efficient, and basically what we're trying to do is make the beneficiary the charity or the family and not the IRS. We're working on ways to increase our giving through cutting out the IRS.
So one of the ways that we can kind of remove the IRS a little bit is through something called donor-advised funds. This is a gifting strategy where we need to have a sponsoring organization, usually like a mutual fund company or something like that, and we can donate to the donor-advised fund, and then over time, that fund can give money to the charities that we have in mind. Now, earlier, Brian had mentioned the idea of if you do all your giving in 1 year, and then you skip a year. So basically you do 2 years worth of giving, and then the next year you don't do any giving, so that we can hit that itemized deduction threshold. Well, with donor advised funds, you can give 2 years worth of money to it, or even more if you want to, take the deduction all at once. And then over time, that you as the donor can say, I want some money to go to this charity, to that charity. You get to determine the timing and the charity that it goes to. So some advantages of this: one is the tax deduction. You do get to take the deduction when you make the donation into the fund. So you get to deduct it now, even though the donation isn't going to the charity until sometime later. Another advantage is privacy. When you give money to a charity, you usually write a check or something like that. It goes to the charity, so they know who you are. And that's fine most of the time, but sometimes people want to remain anonymous in their giving. And so when you give to a donor advised fund and then say, I want you to send a donation to this charity, and I'd like to remain anonymous, the charity doesn't know who the money came from. It knows what a donor advised fund company it came from, but it doesn't know your name specifically. Another advantage has to do with the idea of family values. It's one of those things where you can start a tradition where you're giving to this donor advised fund, and then talking with your family about things you want to support from it, and then sending money to those things. So it's a good way to pass on those family values. It's another form of legacy. Now, there are a couple of disadvantages. The primary disadvantage, or one disadvantage, is loss of control. When you give the money to the donor advised fund, you're giving up legal ownership. Now, companies that set these up, they say, we will take your advice. You're advising them on where to give to the charity. But legally, it's their money, it's the fund's money to make donations. Secondly, donations can only be made to charitable organizations. If you wanted to give to an individual or someone to go to school, Brian talked earlier about scholarship funds, those kinds of things, you cannot do that through donor advised funds.
So what happens is that we need to really think about other opportunities to use our money to create charitable organizations. I've had clients actually set up a private foundation. One case, we set up a private foundation through an organization, and that organization will pay out the payments each year. And we actually gave a lump sum contribution to this foundation to set it up. It was during a year when the client was able to sell a business and receive a large income. And we wanted to take and basically tithe some of that money back. And we wanted to be able to create a foundation that would then make payments for the long term towards a bunch of different missionaries in this case. So a private foundation is a 501c3, so you need an accountant, and sometimes you need an attorney to review the paperwork, make sure you have everything right. It is tax deductible when you put money into it. If it's your private foundation and you own it, that private foundation has to have a board meeting and notes. It has to file a return every year on what came in, what went out. And the advantages of this is when you put money into it, it's a tax deduction. And then that foundation donates that money over time. By you being on the board of the foundation, you and your family can control the distributions over time. And then the contributions can really come from anywhere. And by doing this as a family, you can teach the kids really how to use money for legacy and for blessing people from what God has blessed you. Disadvantage is that a private foundation has a cost to it. There's accounting costs every year. There's just tracking it all. It takes time. There is complexities. Tax deductions are limited to what you put in. There's no additional, but the foundation can pay some of the costs of getting it all paid out. But the best thing about it is you can fund it, control, and you can give the money to the charities that really mean a lot to you. So it makes it an excellent way to give money to families and to other missionaries that are part of your regular group that you'd like to give to.
So we've talked about a couple of little more complex ways of giving to charities, but that are interesting. There is a fairly simple way that we can give to charity as well if we own appreciated stock. So if you own a stock and you've had it in a taxable account, it might be an individual account, joint account, it might be in a trust or something like that, and you've had it for a long time and the value has gone way up, and you think, I'd really like to give money to charity. And your first thought might be, I'm going to sell that stock and then give the cash to charity. What I'm going to tell you now is stop. Don't do that. You can actually give the stock directly to the charity. If you sell it and then give the cash to charity, then you're going to pay tax on the capital gain. If you give the stock directly to the charity, then you're not selling it. You don't pay tax on the capital gain. You do get a deduction for the value of the stock on the date that you gave it to the charity. And the charity itself, because it doesn't pay taxes, they can sell the stock and not pay tax on any capital gain. It's a wonderful way to maximize what the charity is receiving from your giving. So that's a way of using appreciated stock, highly appreciated stock, to do some charitable giving. A second way is using life insurance. And I'm going to let Brian talk a little bit about how to give life insurance to charity.
Yeah, so life insurance, if you have one of those old policies, parents might have bought 40, 50 years ago or longer, those policies might have a cash value. Let's give an example of cash value of $3,000, death benefit of $5,000. If we give that policy and make the owner the charity and give them the policy that they can hold or do whatever they like with it. What I mean by that is they could They could cash it out and get the $3,000 right now, or they could wait till you pass away and get the death benefit of $5,000, but it's their policy. Upon the actual gift of that policy, you can take the cash value amount as your charitable deduction that year. If you want to give life insurance upon a death, you don't get a charitable deduction, but you can make a beneficiary of your life insurance charity and they'll get it and they'll be able to use that money. We would advise that you give your IRAs to charity and life insurance to family when it comes down to it. If you have an old small policy you want to give now so you can get a charitable deduction of cash value, that's a really good idea. We have done that a few times. These ideas all work well together. We highly recommend you talk to one of us at Acres Financial Group to go over how to do this. When it comes to stock, appreciated stock, what we do is we contact the charity. We talk to usually their endowment people, and then they get us in contact with their stockbroker, and we get the paperwork arranged for you to sign so that we can give the actual stock to charity. On the date of the actual gift arriving at the charity, the value of the stock that day becomes what you can take off your taxes. The charity typically will write a letter of thank you to you, stating the day that they received it and the value of the stock on that day. The charity receives the stock and they can do whatever they want with that stock after the fact. They can keep it, they can sell it, whatever they choose to do. You are no longer the owner, they are. It's a wonderful gift. It's a great way of taking highly appreciated stocks that if you like to sell it, but the problem is you don't want to pay the taxes. You want to give money to a charity. It's a win-win. So these are some ideas on ways to send your money to charity when it comes to your highly appreciated stocks or old cash valued life insurance plans. Now on to our next topic. We're going to talk about a more complex concept called a wealth replacement trust. This is where the goal is to cut the IRS out of being one of your beneficiaries of your entire estate. This fits some situations, but we can do smaller versions of this in many different ways. But Jeff, why don't you go ahead and explain this real easy one for me?
Yeah, well, we kind of, as we've gone through these strategies, we started out with ones that were a little bit complex, and we talked about a couple that are pretty simple with the giving stock or a life insurance. Well, now we're actually going to the complex kind of ways to give to charity. So in a wealth replacement trust, let's say you have an asset that you want to donate to charity, but you also would kind of like to have money to leave to your family, to your kids. So you take the asset, it might be highly appreciated asset. We talked about donating stock before. You give that to this charity. It's a charitable remainder trust, annuity trust in this instance. And let's say in this example, you give $500,000 to it. Well, then you buy a life insurance policy with a death benefit of $500,000. Now you're thinking, well, what does that do? Well, the $500,000 is now tax deductible. You gave it to a charity. And depending on how it's set up, it's in a charitable remainder annuity trust in this case. That annuity is actually going to send you income for a period of time. That income comes to you, so you're still getting use, if you will, of that asset because you're receiving income from it. And then down the road, when you pass away, the life insurance, which we put that into an irrevocable life insurance trust, pays off. The $500,000 that you gave to the charity stays with the charity. That's theirs. But now your beneficiaries receive $500,000 of life insurance, which is tax-free. And when it's inside an irrevocable life insurance trust, it's also estate tax-free. Now, the estate tax exemption is pretty high right now, but there is talk of bringing it down. And if it does come down, then this is the kind of thing that could fit for more and more people over time. So this is the most complex strategy that we're going to talk about today. I know this was broken into 2 pages, but we've already covered this page. The remaining balance goes off to the charity, and the value is not part of your taxable estate. And then the life insurance goes to your beneficiaries. It might be your spouse, your kids, or whoever you've named as a beneficiary.
So wealth replacement trust is a concept where you use life insurance in a trust that makes it estate tax-free and income tax-free. Life insurance is typically income tax-free to whoever receives it, as long as you own it personally or in an outside trust, not a company. So wealth replacement is a concept of how to replace money with life insurance. This is typically done when people are healthy. We need to design ideas like this. If you have big ideas on giving to charity and you want charitable giving done the right way, we recommend that you sit down and talk to a planner to accomplish this. So as we close up here, Jeff, I wanted to thank you for paying attention and talking us through some of these charitable ideas. And thankfully, Jeff and I are allowed to get closer together now. We even don't fit on the same screen still. Still is good. So this webinar is actually our last in a series of webinars that we started last fall. We're not going to have a webinar on our schedule in 2 weeks. What we're going to do is take a couple months off during the summer for webinars, but we're going to design a special webinar in July. In July, most likely in July 29th, that Thursday night, we'll have a webinar for the stock market update for the first 6 months of 2021. That talk will be at 4 o'clock that day, and we'll put that together. Throughout the summer and throughout the rest of the year, we're planning on having a radio show, Winning in Retirement. Jeff Akers and Alex Monk join me on that show each and every Saturday morning at 11 a.m. 105.7 The Fan, where we go over many of these financial topics. You can always check us out on our own website, acresfinancial.com, and hear past radio shows, past webinars, and of course, check out everything about Acres Financial. And of course, you can also log into your accounts through eMoney, right, Jeff?
That's right. eMoney is a wonderful tool. We encourage you to use it.
The website has a lot of information there. We do thank you guys very much for listening today. We want to help you with your charitable giving. Today's talk was about charitable giving the right way. When we give to charity the right way, what we're doing is taking things that are in our heart and making it happen, taking the action that's needed. Charitable giving begins with a willing heart. And then what we do is take a look at all the options out there and see what fits best for you. Once again, thank you for listening today and enjoy the rest of your day.
We'll see you again soon.